Okay, it's 1 o'clock, so let's go ahead and get started today. All right, good afternoon, everybody. How's everyone doing today? Doing good, doing good. Yeah,
Good.
end of week 8. Yeah, good, good. Yeah, it's hot. So you guys can't see it, but like my computer chair is actually right next to my air conditioning. So like I have it kind of full blast on me. So it's kind of nice. Otherwise it'll be very hot. Yeah.
My parents are trying to save electricity, so there's no AC right now.
Oh man, oh that's rough. Yeah, AC is definitely a godsend on days like today. So I feel for you.
Unlucky.
Okay, so the plan for today is we're going to finish up our notes on taxes and depreciation. So we don't have that much left, so I think we just have just a few more concepts. Then I think if we finish early, I do want to take a little bit of time at the end of the day to talk about our the final project for this class. So now that we're past the halfway point, I think now is probably a good time to think about, so the final project is going to be based on the ethics portion of the class, but I think, we can at least discuss it now, and it's going to be a group project too. So I think, now's a good time to think about, who you want to work with and, what kind of project that you want. Okay. Just kind of briefly right now. So the final project is basically just going to be a case study report. So, once we get to the engineering ethics parts, we'll learn that, there's been a lot of scandals, I guess you can say, of poor engineering ethics throughout history. And so what your project is going to be is to take one of those case studies and really do a deep dive into it and just talk about just everything that's surrounding it. So not only, of course, the bad decision that was made, but also just the context in which it was made as well. Because what we'll learn in the ethics portion is that, if you look at some of these cases in a vacuum, they might seem, really bad, because you can look back at, just a simple thing like the one that we'll cover a lot is like the Ford Pinto, which is, a car that was extremely unsafe. It's very easy to say now if we could talk to the Ford engineers back there, we could just simply say, just don't do that, right? But it's usually a lot more complicated than that, and there's a lot of context that surround these things. So your goal for the final project is to take one of these case studies and really just pick it apart and just talk about every kind of perspective that you can. But we'll talk about that more at the end. But the reason I want to bring that up today is again, because it's a group project, and I know how group project can be, and I think especially now in the pandemic, it's going to be even harder to coordinate and to meet up with your group. So I want to get this out to you guys sooner rather than later, so that you can start planning for it. Because that's going to be the main thing you're going to be working on for after the second. Okay. So before we get started today, are there any questions that I can answer? Okay, so let's go ahead and get started. Okay, so where we left off last week was, we started talking about depreciation, right? And so the idea with depreciation comes from the fact that if you buy, a big piece of machinery or, a big, we call it a capital purchase before, that piece of machinery or that big purchase, it's going to lose value over time. Okay. And kind of, I think the one that probably a lot of people are familiar with is like a car, right? So everyone's kind of familiar with, a car that you buy, a few years ago. Every year that you drive it, or for every mile that you drive it, that car is going to lose value. So, you're never going to be able to sell your car that you're driving now for the same price that you bought it with, just because naturally over time, as it's used up, as it's, sitting, in your garage, in your driveway, on the street, it's going to lose value. Okay? And so for our purposes, we're looking at depreciation from a tax point of view, okay? And so the idea with depreciation and taxes is that, if you're using a piece of machinery to produce income for your business, you can deduct part of that cost from your taxes, from your taxable income. Right. Because what we're essentially saying is that, we bought this piece of machinery and it's going to last us maybe like 5-10 years. And each year, we're going to lose value from that. Say, we bought a manufacturing machine or a truck, and each year it's going to lose $8,000 worth of value. So we can take that 8,000 and we can deduct it from our taxes so that we don't have to, pay as much for tax this year. Okay? And so last time we went over two methods on how to compute what we call a depreciation schedule. And so a depreciation schedule, you'll see that term come up in your homeworks and in real life too. All that basically means is that we want to compute how much cost is depreciated each year. So it's just basically just an organized table. So basically the tables that we've done before, but just for the depreciation. Okay. And so last time, we went over kind of the first two methods on how you compute depreciation. So the first one you did was straight line. So straight line was kind of the most straightforward, I think. And so with straight line depreciation, the amount of value that your piece of machinery loses each year is constant. So we basically just go, a straight line from its initial cost down to its salvage value, and that's kind of where it gets its name. And so the other one that we did right before the lecture ended was declining balance depreciation, where the rate of the depreciation is the same each year. Okay? So the way the declining balance works is that you compute your depreciation, and then for that year you compute the book value, and then your depreciation charge for the next year is just going to be a certain percentage of your book value. Okay? So we did an example where that rate was 40%. And so today we're gonna finish this off. So we're gonna go over the last two methods. Okay. And so the first one that we're gonna go over is called bonus depreciation. Okay. Okay. So bonus depreciation, it's the reason it gets its name is because it basically allows you to do depreciate a large percentage of your assets costs right up front. Okay. And the amount of this deduction is usually based on a percentage of the initial cost. Okay. And so the way bonus works is that, when you're making your after-tax cash tables, and say that we have a bonus depreciation of 50%, then what you're going to do is that you're going to take your initial costs, multiply by 50%, and then that's going to be an additional depreciation on year one. Okay. And so, the bonus depreciation actually can be as high as 100%. And so under 100% bonus depreciation, you can basically depreciate the entire cost of your machine right up front, which is, like we talked about at the end of the last lecture, which is something that's really good because that gives you a lot of money to use right now. Okay. And so if I'm not mistaken, I think with the tax rules right now, I think there is 100% bonus depreciation right now, but I haven't checked in a few months. But last time I checked, I think it was that. Okay. Okay. And so on the next page, I'm going to do an example, just basically how to show you how to do these calculations. So bonus is actually, one of the more simple ones to do. So it's not too bad. Before we get there, are there any questions on this? Okay. Okay, and so let's do the same example that we did before. When I said before, I meant in the last lecture. But this time, let's use 100% bonus depreciation. And so if we assume, just like before, interest rate of 10%, okay, and we want to find out what the after-tax present worth is. Okay, so let me draw out the table again. Okay. So remember, this was a 5-year horizon, so we have 5 years here. And so our next column here was our before tax cash flow. So, you know, these are the cash flows that we were using for our problem before we consider tax. Okay. So BT stands for before tax. Right. Our next column is our depreciation, or how much tax deductions that we're going to claim from depreciation. Right. And so after that, we can compute our taxable income. Then we can compute our taxes. Okay. And then once we compute our taxes, we can subtract them from our before tax cash flow. And then finally, we can have a column for our book value. Okay. So book value, remember, that's the kind of the current value of our piece of machinery in terms of taxes. Okay. Okay. So just to kind of summarize, our machine looked like this. Okay. So we have an initial cost of $50,000, okay, and that's in year 0. And then every other column, remember, is going to be just blank because that's the first year. So we didn't pay any tax on it. Okay. And then every other year after that, we have a 20K or 20,000 in revenue. And then in the last year, we have our 20K revenue, and then we get an additional 10K because we salvaged the thing. Okay. Okay. And so now let's compute the depreciation. Okay. And so what we are given in this problem is that we have 100% bonus depreciation. Okay. Okay. And so what 100% bonus depreciation means is that we can take 100% of the initial cost and then depreciate that all in year 1. Okay. Okay. And so in this particular case, our initial cost is 50,000. Okay. And so if we multiply that by 100%, which is just 1, then we have a depreciation charge of 50,000 in year 1. Okay. And so if we depreciate all 50,000 in year 1, that means at the end of year 1, our book value is going to be 0 because we've basically taken off, you know, all the initial costs, right? So remember, the way that we compute book value is we take the initial cost and we subtract all of the depreciation charges to date. And since, you know, at the end of year 1, we depreciate everything to the bonus, at the end of year 1, then our book value is always going to be 0. And so every year after this, you know, since we've already depreciated everything from our initial cost, okay, we're going to have just all zeros here. Okay. Right. So bonus depreciation, you know, you can see it's at least when you have 100% bonus, it's really simple. You just depreciate the entire thing up front, and then everything else just can be zeros from there. Okay. All right. So let's fill out the rest of the table. And so in our second column, we have our taxable income. And so remember, for taxable income, we take our before tax cash flow, and then we subtract it from our depreciation. And so in this case, we have 20,000 minus 50,000. So we have a negative 30,000. Okay. And I'll show you what I'll tell you what a negative taxable income means in a second. Okay, but first let's compute our taxes. And so our taxes are just going to be 21%. Okay, so we're still assuming a 21% federal tax rate. Okay, and so 21% of minus 30,000 is going to be minus 6,300. Okay. And so if we have minus 6,300 taxes, what that means is that we actually get a tax credit. Okay. And so since we depreciated so much of our initial costs up front, if we have a negative taxable income, that means we're actually going to get some money from our taxes. We get like a tax return. Okay? And so our after-tax cash flow is going to be our before tax, which is 20,000, minus our taxes. So 20,000 minus a negative 6,300, and what we get is 26,300. Okay. Okay. So that's really good, right? And so with bonus depreciation in year one, we actually, pay negative taxes, which, we get a tax break, okay? Okay, and so everywhere else, we can just fill in the rest of the table. So since we have no more depreciation after that, our taxable income is going to be 20,000 each year, okay? Except the last year, which is going to be 30,000, okay? And then our taxes each year are going to be 21% of that, okay? So we have 4,200, 4,200, 4,200, and 6,300. Okay. And then we subtract them to get our after-tax cash flows. Okay. Okay. And then now that we have these after-tax cash flows, we can use them to compute our present worth. Okay. All right. Any questions on this?
Yeah, Professor. Where did you get the 21% from again?
So that's given in the problem. So 21% is just the federal tax rate. So that's how much the federal government is going to tax you on your income. Yeah.
All right. Thank you.
Okay. Okay, so then once we have those after-tax cash flows, we can compute the present worth. Okay, so you can do this in a lot of different ways. In this case, it's the numbers are actually kind of nice, so we can actually plug in some uniform series. Okay, and so the way I computed is I did minus 50,000, so that was our initial cost, plus 15,800. It's going to be P over A, 10%, and 5, plus, this is the additional amount of money that we got in year one. So it's going to be 26,300 minus 15,800, P over F, 10%, and 5. Okay, and then we have the additional money on year 5. So then, oh, sorry, this is year 1. 1. And this is 23,700 minus 15,800. Okay. P over F, 10%, and 5. Okay. And you plug in all the numbers, and what you get is 24,348 and 46 cents. And so I know we did that at the last lecture, but if we compare this to the straight line depreciation and the double declining balance, this is our highest present worth of them all. Okay. Right. All right. Any questions on this? Yeah, so remember the reason this is the highest present worth of them all has to do with the fact that we depreciated so much up front. Okay, and so if you remember, kind of at the end of lecture on Tuesday, what we says that if you're a business or you're an engineering company and you're working on your taxes, what's most beneficial for the company is if you front load as much depreciation as possible. Okay? Okay. And remember, this all goes back to our understanding of, you know, the time value of money, right? And so if you look from this table right here, if you front load all the depreciation, you get all this money up front, right? And by up front, I mean, you know, sooner rather than later. And so with that 26,300, you know, as opposed to, you know, the lower values for some of the other depreciation methods, you can take that money and you can spend it on something else, you know, for your company. And so that's why the present worth of this method, where you depreciate it all up front, is going to be, you know, the best one of them all. Okay. Okay. So that's bonus depreciation. So bonus depreciation is pretty nice, and I think that's what's actually in law right now. Okay. But there's one more depreciation method that we can go over, and it has the longest name. But it's actually not as bad as what the name specifies. Okay. Okay, so the last depreciation method that we're going to go over is called Modified Accelerated Cost Recovery System. Okay. It's a mouthful. And so with anything that has this absurdly long of a name, it has an acronym. Okay. Okay. So it's MACRS, okay, or MACRS if you want to say it in one word. And so just a little bit of history. So this was this system was introduced into law as part of the Tax Reform Act of 1986. Okay. And it was introduced as kind of a way to simplify tax calculations. Okay. Okay. And so for a long time, this system was pretty popular, and it was popular for three reasons. Okay. And so one, what you'll find out is that you know, when you're computing the depreciation for a certain object, you have to assign it what's called a property class. Okay. And so the property class basically defines what kind of object it's going to be. Okay. And so based on what kind of object it is and what class it's given, you know, that's going to determine its useful life. And so people like this, businesses like the system, is because you know, the assigned or at least the government determined property class life is often shorter than the actual useful life. And so what that means is that it basically, under this system, it basically allows you to depreciate more of your cost sooner, right? So just like we talked about with bonus depreciation, is that if you can depreciate all of your cost, you know, upfront rather than later, that ends up being more beneficial for your company in the long run. Okay? Right? And so another reason it's popular is that the salvage values are assumed to be zero. Okay. And so this oftentimes this you know, simplifies your calculations quite a bit, and it ends up with more money for the company too, because, you know, under this system it assumes your machinery, you know, you're not going to be able to sell it, but you can still sell it at the end. Okay. And the third reason it's popular is that it gives you just a table of percentages, and so this really simplifies your calculations. Okay. All right, so let's go over the property classes, okay? And so just like I mentioned before, depending on what type of object that you have, it's assigned, you know, a life under this MACRS system, okay? And so I'm going to start the table, and I think probably going to continue it on the next page. Okay. And so there's 6 of them, and each of the 6 classes defines how long that they can operate. Okay? And so our first class is going to be 3-year properties. Okay. And so these are devices, or these are machines that are generally expected to last 3 years. Okay. And so I'm not going to write down all of these because it's a lot, but you can find the full list in the posted lecture notes. Okay. And so I'll write down some of these. So like one example could be like food or beverage handling devices. Okay. Another thing could be plastic manufacturing. Okay. And a big one over here is motor vehicles. Okay. And so just as a quick aside, let's look at this last one right here, right? And then let's compare that to kind of point 1 right there. And so under this MACRS system, they basically assume that your motor vehicle, you know, at least in terms of tax purposes, your motor vehicle is going to lose all of its value in 3 years. Okay. And if you've ever driven kind of an older car, you know that, you know, you can get a motor vehicle to last a lot longer than that. Okay? But for tax purposes, this is really nice because, you know, that means under this system, over those first 3 years, you can depreciate the entire cost of, you know, of your car that you're using for delivery or something for your business. So that means more money that you can have up front that you can spend for other things. Okay? I had a friend in graduate school who still drives his mom's soccer van. Like the door handle is literally being held together by duct tape. So I mean, I know people make jokes about, like, you know, their cars held together by duct tape all the time. But this guy, his car was literally held together by duct tape. One of them didn't open, so you had to go to the other side, and you have to be really careful not to actually break it. It was a marvel that this 25-year-old Honda Sienna was still kicking it. It was like an ugly ass, like, beige color too, but you know, he loves that car, so you know, nothing I could say could ever get him to abandon it. Okay, so the next class of properties are 5-year properties. Okay, so some examples of this could be like a truck. Okay, aircrafts are considered to be 5-year property. All right, research equipment. Computers. Okay, so a lot of things end up falling under the 5-year property. Okay? So the question is, does that only apply to business vehicles? So remember, you know, in order to apply depreciation for your tax purposes, it has to be used to earn money. And so I'm actually not sure, you know, like say if you're like an Uber driver or something, right? So if you're an Uber driver, I don't know if you can, if this can apply to your taxes. I haven't actually looked that up before, but I presume that if it is, and you can argue that you use your personal vehicle to earn income for yourself, then you can use that to deduct money from your taxes. But you know, if it's just your personal vehicle that you're just you know, just driving for personal reasons, you can't deduct that from your taxes. It has to be used to earn you some income. Of course, you know, all this is really complicated nowadays with, you know, e-commerce and, you know, everyone using everything to make some money. And so just like with this 5-year property too. So, you know, say if you're, you know, you stream on Twitch or something like that, or you do a lot of, like, you know, day trading with your computer, you know, I'm sure you can argue that, you know, you can deduct part of the cost of your computer from your taxes. Okay, any questions on this? Okay. Okay, so that's the first 2. And so our next one is going to be 7-year properties. Okay. And so for 7-year properties, this might be kind of surprising or maybe not. So under 7-year properties, believe it or not, office furniture is part of it. Okay. Fixtures. Okay. And the 7-year property is pretty big because this 7-year property covers all other assets. Okay. And so for things that don't have or that doesn't fit well under all the other properties, they kind of just throw it all together into 7-year. And because the reason for that is because the 7-year property is kind of, you know, in the middle of everything. Okay. So I think those are the ones that are, you know, relevant for, you know, most of the things you're going to encounter. But I'll go over quickly over the last one. So now we have our 10-year properties. And so the 10-year properties could be like petroleum refining. Okay. And water transfer equipment. Okay. Then we have our 15-year properties. Okay. And you'll start to see, you know, a lot of these are kind of more like public works, municipal stuff. So this could be like telephone stuff, like telephone lines. Municipal sewage treatment plants. Okay. Okay. And the last class is 20-year. Okay. And the only one I have listed here is municipal sewers. Okay. Okay. And so that's just kind of a brief overview. So I mean, this is a very incomplete list. So you know, I have a bigger list in the lecture notes, but you know, you can find an even bigger list if you search online as well. Okay. But the most important thing, at least for us, is, you know, how do we actually compute depreciation under MACRS? Okay. And so the way that we can compute depreciation, okay. And so I'm going to denote this this variable here called d sub I. Okay. And so this d sub I right here will be the depreciation for year I. Okay. And so this is basically what you would put in that row in the in our after-tax cash tables. Okay. And so it's going to be C times R sub I. Okay. And so C right here, this is going to be the initial cost. Okay. The initial cost of our machine. Okay. And then RI right here, this is going to be the rate or the percentage that's obtained from a table. Okay. And so this table I'm going to define on the next page for you. Okay. All right. Any questions on this? Okay. Okay. And so, you know, depending on what property class you're in, these are the rates that you're going to apply. And so I'm going to make a table. And so this is going to be from years 1 through. So I'm only going to list the rates for up to a 10-year property, because the 20-year gets a little bit too long to write. Okay. Okay. And so that's how it's broken down per year. And so we're going to have one column for a 3-year property. Okay. Next, we're going to have a column for a 5-year property. Okay. next we're gonna have one for a 7-year, and then I'll do the 10-year as well. Okay, so for a 3-year property in year 1, you're going to depreciate 33.33% of your initial cost. Okay. In year 2, you're going to depreciate 44.45. In year 3, you're going to depreciate 14.81. Right, and in year 4, you're going to depreciate 7.41. Okay, and then it's going to be blank for the rest of the table, right? Because it's a 3-year property, so you're only going to depreciate up to that. Okay.
Professor, I don't know if I missed something, but do we not use year 0 in these cases?
Right. So we don't use year 0 because remember, for year 0 we don't apply depreciation because we don't pay taxes in year 0, right?
Yeah.
Yeah, so if you kind of look back at this example here, you know, in year 0, we just purchased the machine, so then we don't pay taxes on this.
Oh, okay.
Yeah, you might have paid sales tax, but, you know, we're only considering just income taxes on this. Yeah.
All right, sounds good. Thank you.
Okay. And so what you'll notice, and so one thing that you'll notice from here is that, first of all, generally the rates go down in later years, with the exception of years 1 and 2, right? And you should also notice that even though we have a 3-year property here, oh shoot, we have something in year 4, right? So what's up with that? And so the reason for that is because year 1, what we assume in year 1 is that you know, the asset doesn't actually get placed in service until the middle of the year. And so under the system, it basically assumes that under that first year, you don't generate any income from this machine for the first 6 months. So like January to June, you don't make any income. Okay? And so basically what that assumes is that if you're not going to be using the machine for that first 6 years, I mean, for that first 6 months, you know, you can't deduct anything from your taxes on that. Okay, so that's why year 1 is always going to be slightly less than year 2. So in year 2, you get a full year's of deductions, and it's kind of front loaded for that. And then under the same assumption, the fact that we don't actually depreciate until halfway through year 1, we depreciate halfway through year 4 as well. Okay, and so this 7.41 in year 4 has to do with the fact that we're assuming that we're going to use this machine until halfway through year 4, and so that's how much we can deduct from our tax. Okay, and so that kind of that's kind of you have kind of a weird things in the first and last years for under MACRS, under that kind of, they call it the half-year convention. Okay, and so let me fill in the numbers for the rest. Okay, so under 5-year properties, we start with 20%, then go to 32%, then 19.2%. Okay, and we have 11.52%, 11.52, and then year 6 we have 5.76. Okay. Right, for 7-year, we have 14.29, 24.49, 17.49, 12.49, 8.93, 8.92, 8.93, and 4.46. Okay, and then 10-year, we have 10, 18.0, 14.4, 11.52, 9.22, 7.37, 6.55, 6.55, 6.56, 6.55, and 3.28. That's 11. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Yep. So I guess there should be an 11 down here that I missed. Okay. All right, so what we're going to do next, I'm going to show you basically how to do this in an example. Okay. All right, any questions on the rates here? Okay. All right, so let's do an example. Okay. And so with this example, we're going to do the exact same example that we've been doing, but instead of all the other depreciation methods, we're going to use MACRS. Okay. So let me write out the entire table. Okay. So we start out with the year. So 0, 1, 2, 3, 4, 5. Okay. Okay. So then we start with our before tax cash flow. Then we have our depreciation. Okay. Then we have our taxable income. Okay. Taxes, after tax. Okay. And then book value. Okay, so let me fill in the before tax cash flows, just like we did before. Okay, so you have minus 50,000, 20,000, 20,000, 20,000, 20,000, and 30,000. Okay. And again, in year 0, since we haven't paid any income taxes yet, we're going to just have all blanks there. Okay. Okay. And so, if we're going to do this with MACRS, we need to assign a property class for this. Okay. And so in this particular case, I think we had this was a truck. And so for a truck, what we're going to do is, we're going to assign it a 5-year property class. Okay. And so under the rules of a 5-year property class, we're going to use the second column for the rates right here. Okay, so let's start with year 1. Okay, and so in year 1, the way that we're going to compute our depreciation is we're going to take our initial cost, which is 50K, okay, and then we're going to multiply that by the rate. Okay, and so our rate in year 1 for a 5-year property class is just going to be 20%. So we're going to multiply 0.2, and that gives us 10K. And so if our depreciation is 10K, then our taxable income is going to be 10,000, then our taxes is 2,100, okay? And our after-tax cash flow is going to be 17,900, okay? And so since we depreciated 10,000 in year 1, then our book value is going to be 40,000, okay? Okay. Right, so then in year 2, we're going to depreciate 32% of our initial cost, so that's going to be 16,000. Okay. And so our taxable income is going to be 4,000 that year. Okay. And so our taxes are going to be 840. Okay. And our after-tax cash flow is going to be 19,160. Okay. And then our book value is going to be 24,000. Right. And then we can continue on in the same way. So I'm not going to write out the rates because you can see them on the previous page. Okay. Okay. So those are all depreciations. So let me fill out these. Okay. And so when we get to this last year, you know, I'm going to do something a little bit special here. Okay. If you notice in the previous year, in year 4, we're left with a book value of $8,640. Okay. And so what that means is that our truck has $8,640 of value left. Okay. And so under MACRS, you know, in year 5, we're only going to depreciate 5,760 of it. Okay. And so that's less than the 8,640. Okay. And so after we apply this one, we're going to have a 2,880 remaining. Okay. Okay. And the way I got this number is that this was the remaining book value after we applied the depreciation. Okay. So since, you know, we're performing this analysis, we're only doing it for 5 years. You know, we're not going to have something after that, and so we have to make sure that we end up with a book value of 0 at the end. Okay. And so in order to get a book value of 0 at the end, we have to depreciate basically the rest of it in the last year. And so our depreciation for that last year is going to be 5,760, which is what we usually get from our MACRS system, and then we add an additional 2,880, which is the remaining book value. Okay, and then the rest of our table kind of fills out like that. And so you can compute the present worth. Okay, and then what you get from this is 22,951.32. Okay, so you can see this is less than 100% bonus depreciation, but it's still higher than straight line and declining balance. And so, you know, the most desirable thing is to do 100% bonus, but this MACRS system usually gets you a pretty good present worth as well. Okay? And again, you know, which rule that you end up using depends on the law at the time. And so I think right now the law is that you can do 100% bonus depreciation, but you know, this MACRS system is written into law, so you know, we might go back to the system, you know, at some point too. So. There's a kind of a lot of rules to it, but then once you kind of assign the property life and you know what you're doing, you know, actually calculating the depreciation is pretty easy because it's just a percentage off of your initial cost. Okay, any questions on this?
Yeah, what did you do on that last step?
This last step, so if you look at the book value at year 4, you can see that we still have 8,640 left, right? And so, you know, ultimately what we want is that at the end of year 5, which is the end of our tax calculations, you know, we want to have a book value of 0. And so the way that we achieve that is we go to the next line and we say that we're in year 5, okay? And so in year 5 of the MACRS table, we can see that we have to depreciate 11.52% of our cost, right? And so the way that we got this 5,760 is we took 11.52% of our initial cost, which is 50,000. Okay, so this 5,760, this is kind of like the normal MACRS charge that you would do for depreciation. Okay? But since this 5,760 is less than the 8,640, you know, we're going to have some left over for our book value. And so in order to make sure that we reach a book value of 0 at the end, I just added the difference right there, okay, which is 2,880. And so another way that you can say this is that for this last year right here, in order for us to reach a book value of 0, we have to depreciate a total of 8,640, because that's what it was in the previous year. So, you know, the 5,760 and the 2,880, that's just, you add them together, and that's how you obtain that, basically.
Thank you.
Yeah. All right. Any more questions on this? Okay. So that's the 4 systems of a depreciation. Okay. And so, you know, we've done an example of how to do each one in a vacuum, but in reality, you can actually combine these depreciation rules together. Okay. And so here's where things get a little bit more complicated. Okay. Or in other words, you know, you'll be able to combine bonus depreciation with other methods. Okay. And so in this example right here, I'm going to show you how to combine bonus and MACRS. Okay, so let's say that you know, you work for an engineering company, and they recently purchased $150,000 worth of computer parts. Okay, and so that $150,000 is going to be our initial cost. Okay, and the types of objects that you bought was computer parts. Okay. And so that's important because remember, for MACRS, we need to assign it a property class. Okay. Okay. And so the revenue that it produces each year is going to be 50,000. Okay. Okay. And each year, it's expected to have to cost them to maintain your computers, and that's going to be $10,000 per year. Okay. And so if we assume that the computers belong to a property class of 5 years, okay, okay, and we assume a salvage value of 25,000 after 5 years, okay. And so that's all the before tax cash flows. Okay. So now let's define the tax stuff. And so we're going to say that these computers are subject to a 40% bonus depreciation. Okay. And then the rest of the cost is going to be made up by MACRS. Okay. Okay. And so if we assume an interest rate of 8%, okay, let's compute the after-tax EUAW. Okay. Okay. All right. Any questions on the problem setup? Okay. Okay. So the first thing we're going to do is we're going to take is we need to find out our before tax cash flows. Okay. And in particular, I want to look at the revenue and the maintenance. Okay. So if you go back to kind of the very beginning and when we started talking about taxes, we said that any kind of maintenance that you do, or you know, any kind of, we call these a necessary expenditure, we can immediately deduct this from our income. Okay. And so if we immediately deduct our maintenance cost, okay, and so if we immediately deduct our maintenance cost, we're gonna have 50,000 minus 10,000. Okay, so it's gonna be 40,000. Okay. And so right off the bat, we can say that, you know, that $10,000 that we paid out for maintenance, we can already deduct that from our taxable income. Okay, and so each year we're only gonna have $40,000 that are gonna be eligible for taxes. Okay, and we still need to deduct our depreciation each year, but you know, at the very least, we can deduct 10,000 from the 50,000. Okay. All right. Any questions on this? Okay. All right. So the other thing that we need to do is we need to compute the depreciation. Okay. So first, let's do bonus. So we had a 40% bonus here. So you know, the way that we're going to compute that is we're going to take our initial cost, and then we're going to multiply it by the bonus rate, which in this case is 0.4 because we're at 40%. Okay. And so in year one, we're going to depreciate $60,000. Okay, bonus. Right. Okay. And so since we're immediately deducting that 60,000 kind of right off the bat, you know, our starting book value is going to be different. Okay. And so, you know, if we take the 60,000 and we subtract it from our initial cost, what we get is 90,000. Okay. And so this 90,000 here, we're going to, you know, compute our deductions on this 90,000 from MACRS. Okay. And so the MACRS system that we're going to use is a 5-year property. And so just like in the last example, you know, we're going to, for the first year, you know, we're going to compute 20% of this. Okay, so this is for year one. Okay. And so 0.2 times 90,000 is going to be 18,000. Okay. All right. And so if we add this together with our bonus depreciation, okay, we're going to do 60,000 plus 18,000, and so that's going to be 78,000. Okay. Right. And so I'll do a couple more under MACRS just so that you get the idea. Okay. And so in year two, our year two MACRS rate is 32%. Okay. And so we're going to do 0.32 times 90,000. Okay. Okay, so that's going to be 28,800. Okay. And then in year three, our MACRS rate is 19.2. And so year three, we're going to have 0.192 times 90,000. And so that's going to be 17,280. Okay. And so for the first 3 years, you know, these are going to be our depreciation charges. Okay. And so, you know, for most of this table, we're going to follow MACRS, but in year one, we have that additional charge due to the bonus. Okay. And so we have our additional charge of 60,000. We're going to add that to our MACRS value of 18,000. So we get 78,000 in year 1. Okay. And in years 2, 3, 4, and 5, we're just going to follow MACRS on what's remaining after the bonus, which is 90,000 right here. Okay. All right. Any questions before I start writing out the full table? Okay. Okay. So let's write out the full table. Okay. Okay. And so I'm going to leave the book value thing blank for now. Okay. Okay. So our before tax cash flow, we have our initial cost of $150,000. Okay. And then every year after that, we have an income of 40,000. Remember, because we subtracted out our maintenance cost. Okay. Okay. Now let's fill in our depreciation. Okay. So remember, in year 1, we have a depreciation of 78,000. Okay. Year 2, we had 28,800. Okay. Then in year 3, we had 17,280. Okay. Right. And then year 4, which I think the rate is like 11.52%, then we have 10,380. Okay. And then the last year, we also have 10,380, or 368, sorry. And then just like we did, in the previous example, if we depreciate this 10,368 in year 5, we're going to have some leftover book value, right? And so we need to add another 11,184 just to make sure that we end up with the book value of 0. Okay? So this 11,184 is our remaining book value. Okay. Okay, so I'm gonna go ahead and fill in the rest of the table. Okay, so that's all our taxable incomes. Okay, so those are all the taxes that we pay. Okay. Oh, sorry, that's the after-tax cash flows. I switched them up. I'm gonna do the lazy thing. So this is our after-tax right here, and then these are the taxes that we compute. Okay, and so I swapped these tables on accident because I was copying the wrong column. Unfortunately, it gets a little bit hard to write, on this tiny iPad. But like kind of like what I said at the beginning of this unit is that there's a lot to keep track of with taxes. You're gonna have to make a lot of these tables, so just go slow. you know, if you're familiar with Excel and you're good with spreadsheets or Google Sheets, definitely that would be a great tool to use here just to help you stay organized. Okay, just so that then you're not really subject to any kind of hand calculations from that. Okay, so you know, use the tools that are available to you. You know, the important things with these kinds of problems is to stay organized. Okay, so unlike what I just did. Okay, and so after you do all these calculations, you can compute your after-tax. In this case, is asking for EUAW. Okay, and so you want to convert all of these guys into a uniform series over the entire 5 years. Okay, and what you get is 4,096.61. And so after all the taxes and all the depreciation, you know, this investment right here will earn you approximately $4,096.61 each year. Okay. Okay. All right. Any questions on this? Yeah, so when you're doing the homework, remember just go slow. There's no need to kind of rush through these calculations, you know, because there's a lot going on. Okay, so I think you know, with this you should be able to do the rest of the homework now. So this gives you everything you need to do problem 4, and so problem 4, you know, 4A, I think I'm going to ask you to compute a depreciation schedule from scratch. Okay, and so when I mean by depreciation schedule, I mean just compute this column right here. Right? And so unless the problem asks you to compute an after-tax cash flow, you know, you don't have to fill out the whole table. So when I just ask you for the depreciation schedule, just give me this column right here. So you don't have to do the full table. Okay. And so just tell me how much each year that you're going to depreciate the cost of your purchase. Okay. Okay. So I think the homework is due on Tuesday. So I think you have, you know, rest of this week and the first 2 days of next week to do it. Okay. The last one is you know, that one's really hard. So definitely use Excel for that one, just because there's a lot going on with that, because there's state taxes, maintenance costs, and everything like that. So you know, use every tool that's available to you. All right. Any final questions on taxes? Okay. So we have about 7 minutes left in the class. So I do want to talk about the final project a little bit today. Okay. So let me share my my screen. I can pull up, oh, it's right here. Okay, so I'm still working on the specs, but this is kind of the current draft of the project specs. Okay, and so just like I mentioned at the beginning of class today, you know, our final project for this class, you know, in lieu of the final exam, so we're not going to have a final exam in this class, you know, for several reasons. First of all, you know, it doesn't make any sense to have an exam on ethics, I don't think. And second of all, you know, we're in this kind of virtual mode, so it's I think a project kind of fits better with this kind of stuff. And so instead of the final exam, we're going to do this final project. So what this final project is going to be is it's going to be a case study report. Okay, and so what you're going to do is you're going to take a historical example of an engineering ethics snafu. Most of these are going to be you know, some kind of scandal in certain kind of ways, but I know that there's a couple feel-good stories in here as well. Okay, and so what I want you to do is I want you guys to take these case studies and really analyze every single aspect. Okay, and so you can see right here, you know, under this section called project requirements, these are all the different angles and these are all the different things that I want you to write about in your report. So I want you to talk about, you know, the historical context, you know, what was going on, you know, in history around that time. Give me the technical context. So, you know, under technical context, you can really flex your engineering muscles here. So, you know, give me all kinds of calculations, tell me all the materials that they use, you know, give me all the technical details that's relevant for this. Okay. The next section is economic context. So, you know, very relevant to the stuff that we're going over in the class right now. So tell me, you know, what kind of economics and what kind of financial things were at stake for this project. Okay. And what you'll see is that a lot of the times the economic was kind of the economic part was kind of one of the big driving factors for a lot of these incidents. Okay. I want you to tell me about the personnel. So like, give me the names of the people involved, what their positions were, who's making the decisions, who are the engineers, what were they saying. Okay. In every situation, there's going to be some kind of, decision that was made that violated some ethical standards. Okay. So I want you to describe that for me. Okay. Describe it and analyze it. Right. And after that, I want you to talk about the fallout. Give me the impact of, what happened from this, not only in the immediate aftermath, but, a lot of these happened, 40, 50 years ago, and, we're still, feeling the effect of that today. So there might have been laws that were passed, or there might have been, a public perception might have changed in a certain way. So I want you to go over that as well. Okay. And then I also want you to talk about, what else could they have done? So discussion of other, possible choices, and just kind of just a future outlook for these kinds of situations. Okay. So I'm still kind of editing this these project specs. So I'm hoping to post this later this evening, so you can kind of read these in context. But the reason I'm kind of talking about it right now in the lecture is that, this is going to be a group project, so it's not going to be individual. And so what you're going to be working in is you're going to be working in groups of 5. Okay. And so groups of 5 work perfectly for this class, actually, because we have 40. Last time I checked, we had 45 students in the class. Okay? And so we're going to have 9 groups of 5, which I think is going to be, really perfect for this. So, I'm introducing this to you guys now just so that you can think about, who do you want to work with in this project. Okay? Because I know how group projects can be sometimes. It's because it wasn't that long ago that I was working with this, and with group projects, sometimes you kind of have to make a choice about, if I work with these people, am I prepared to, lose my friendship with them potentially? Because it's like, the top 2 things that can ruin, friendships is, number 1 is, monopoly. Monopoly is kind of the devil's game. Number 2 is, you can work on a group project with them and it can go terribly wrong. So, I want you guys to really think carefully about who you want to work with, and, really think about how you're going to split up the work. Okay. And so one of the big things that I want you guys to turn in, just to kind of make sure that everyone does this, their fair share of work, is that our first deliverable right here is going to be what I call an agreement of shared responsibilities. Okay. Yes, you can choose your groups, so it's going to be up to your choice. Okay. And so what this document is basically going to say is that, I've outlined basically all the work that you need to do for this project, all the different research, for all of these things, you're going to need to look up some stuff on the internet, about these things. Okay. And so I've laid out all the work that needs to be done. And so what I want you guys to do at the beginning is, among the 5 of you, I want you guys to agree that, this person is going to take care of this thing, this person is going to take care of this thing. I want you guys to split up the work evenly from the very beginning. Okay. And I know, not all the time it's going to work out perfectly, like you said, but I want everyone to, take some kind of ownership of the project and say that I'm going to do this part. Okay. And then and the other part of this agreement is that you can use that to kind of hold your group members accountable too. So, if you're going to, compile the information for your final presentation, your final report, and someone hasn't submitted their stuff, you can say, hey, we all signed this document here. We really need you to step up just so that we can, we can finish this project. Okay. And so that's going to be the one thing, that's going to be the first thing that you guys are going to need to turn in. So that's going to be due about a month from now. So it's going to be, Tuesday, November 10th. Okay. So it's still a while. So, we haven't started covering ethics yet, but, I want you guys to kind of think about, who you want to be in your group and how you want to split up the work. Okay. And then in addition to that, there's going to be a final presentation. So that's going to take place in the last week of class. And you're going to need to turn in a final report. And then the last thing that you need to turn in is, I want you guys to assess, how your group worked together. So this is going to be due after the final report. Okay. All right, so you can read up, all the different final project components, that's going to be there. Okay. And at the end of this document here, I've listed, some suggested projects. Okay. So these aren't I'm not limiting you to these things, but these are kind of the ethical things that I've thought of, that I've kind of know about, that you can use for your projects. Okay. And so things like the Boeing 737 MAX, so that was actually pretty recent. So if, that's kind of the airplane that Boeing put out that had, tons and tons of issues. There are 2 fatal accidents on this, so that was pretty recent. Okay. Columbia Space Shuttle, so that's a very famous one, that went totally wrong. Okay. And some really open-ended ones. So like, Facebook and digital privacy, I think, is a more open-ended question. Okay. So there's a bunch of these that you can read up, the brief description of what you want to do. Okay. And I'm planning on adding a few more too to these guys. Okay. And again, this list isn't limiting, so you can suggest your own thing as well. Okay. But the important thing is that, we're going to have 9 different groups, and I don't want any group to work on the same thing as the other one, okay? And so at a certain point, I'm going to open up a Google Sheet where your group can sign up for the project that you want to do, okay? And so, I want you guys to kind of start that conversation now, get your group together and kind of, read through this list after I post it, and say, these ones look interesting to me, and, think of maybe like a top 3 that you want to do, okay? So that once I do open up the signups, you're ready to kind of sign up for what you want, and everyone's kind of in agreement on that, okay? Okay, so I'm going to finish. So I'm almost done. I just need to kind of write descriptions for these last few projects here. But besides that, are there just any questions I can answer just immediately right now about the final project? Okay. Oh, I heard someone's mic turn on for a second. Okay, maybe it was my imagination. Okay.
Can we choose our groups?
Yes, you can choose your groups. Yes. Yeah, so you can choose who you want to work with. So it's going to be a group of 5. So you can choose who you want to work with. So and definitely we have the Discord channel for our class too. So if you want to find a group, you want to get a group together, definitely make use of that as well. Okay, but if there's no more questions, that's all we got time for today. So I went over a couple minutes, so I apologize for that. Okay, so thank you everybody for tuning in. There's a new minute paper that's up on Canvas if you want to go fill that out. But if not, have a great weekend and have a great rest of your day, and I'll see you guys on Tuesday.
Have a good day, Professor.
Thanks, you too. Yep, have a good weekend.
Hey, Professor?
Yep.
Just had a quick question about your classes for next semester.
Sure. Yep.
Will you be teaching any ANSYS or simulations or fluids kind of thing?
So I requested to teach 410, which is the undergraduate finite elements class, and I've gotten that the past 2 years. And talking to other faculty, no one is that enthusiastic to teach that. So I'm guessing that I'll probably get that course again.
Sweet.
The other class that I requested pretty highly was 417, which is a computational heat transfer class. So I taught that one last year too, and I really enjoyed that one. But that one was kind of like an emergency kind of step in. So I kind of had to step in on that class at the last minute because the other faculty who normally teaches that, I think his name is Professor Azazi. So he normally teaches it, but then he had to teach something else kind of at the last minute too. So I was asked to teach that one. So I don't know if he's going to teach that one next semester or what his plans are. But if he's not going to teach it, then my plan is to teach that one too. But I think the only class I know for sure that I'm going to teach is probably 410.
410, is that ANSYS? Do you use that or no?
Yes, that's ANSYS. Yep, we're going to use plenty of ANSYS in that class.
All right. I guess to better prepare, because I'm going to need to do some CFD fluid analysis. Did you have YouTube videos already recorded on 410 or?
I think we did do fluids in ANSYS one day in 410. I need to find the video. But the focus for 410 just because it's a lot. Fluid mechanics and finite elements is usually pretty difficult to learn. But I did do one day where I just kind of showed you where all the buttons were in ANSYS. So the focus of 410 is going to be more on solid mechanics and heat transfer, just because those problems are a lot easier to kind of formulate. But there was a lot of requests for CFD, so I did do one day where I showed you how to run just a simple pipe flow simulation. So and if that's something that you want to do, I think probably the better thing is probably we should just meet kind of outside in like office hours or something, and I can kind of walk you through how to do that. Because besides, ANSYS is kind of okay at fluid mechanics. It's not the best though. So there's definitely other tools that are out there that are better for CFD than ANSYS. But we can definitely talk about that offline. I think that's probably the better place for that.
Okay, cool. Yeah, I might go to your office hours. I have a CFD problem regarding my senior design project. It's about fluid through an intake, and for the engine, I want to try and simulate some flow analysis for that. Do you know any other programs like OpenFOAM, ANSYS? What other are good?
Yeah, OpenFOAM I think is one of the big industry standard ones. It's a little bit hard to get working. I personally don't have that much experience with it. Who does have a lot of experience with it is Dr. Myral. He has a lot of experience with OpenFOAM. So I would ask him. So OpenFOAM is nice because it's free, because that's where it gets the name OpenFOAM. and you can really push the boundaries too. So the biggest weakness for ANSYS for fluid mechanics is that, you know, if you're using a legal version of it, not an illegal one, you're very limited in how many elements you can put in the mesh. And so I think the limit for ANSYS is only going to be like 32,000 elements. But even for like the simplest fluid mechanics simulations, you want to push the element count quite a bit. So you want to have at least, like, I would say, in the hundreds of thousands of elements. So that's just not possible with ANSYS. But with OpenFOAM, you can really push that kind of as much as you want.
Right.
Yeah, so I would ask Dr. Myrell. I actually just talked with him earlier this week of getting some supercomputer access for his OpenFOAM stuff. So
Okay.
yeah, he might be dusting all that stuff off. So I would talk to him about that.
Yeah. I'll go to his office hours. Yeah, he's my supervisor, or what do you call, advisor for my senior design.
Oh, nice. Yeah. He would
so just
definitely know about OpenFOAM. So I would ask him. But I'll dig up the YouTube video I have on ANSYS, and then I'll send that to you.
Yeah, perfect.
I'll just email it to you once I find it, because it's somewhere
Okay.
very deep in there.
Yeah, because I see it's just week and then lecture. I don't know which one it was.
Right.
Which one was ANSYS?
Yeah, I'll find it, and then I'll send it to you.
Thank you so much.
Mhm.
So the ANSYS you guys are using, is it just the student version? So it'll have limited amount of inlets and outlets, right? Pretty much.
Yeah. So
Okay.
the student version you can purchase, or you can download it for free.
Mhm.
But you know, we'll also have access to we call it the academic license. And so you know, normally you can use those in the computer labs, but right now, you know, we can't access them. But IT has set up what's called like a virtual computing environment. So you can basically set up like a virtual computer on your machine and access the same academic license from the computer lab. So that one has a slightly higher limit. I'm not sure what the limit is exactly. I think it's like, actually, I don't want to say, but it's more than the student version, at least, because we actually had to pay money for the academic version. So that one's a little bit better, but I think it still wouldn't be enough to do like a real analysis that I would have faith in. So
Okay.
I would say you would definitely need to go with OpenFOAM especially if you're going to use it for senior design.
Yeah. I think that's the plan then.
Mhm.
And then sorry about like not legal stuff, but what do you think about pirating, or like just go with OpenFOAM? It's probably the best way.